Welcome to the Stock Market Palantir. Today we are going to talk about NUAI. We are focusing today on New Era Energy and Digital Inc., which, was formerly NEHC. It's a company with a market cap right now that's hovering around $200 million. And this stock, I think, really exemplifies the complexity of a major market pivot. You're taking a legacy asset base, we're talking natural gas, helium exploration, and trying to transform it into this vertically integrated AI digital infrastructure. NUAI's basically positioned itself right at the crossroads of energy supply and algorithmic demand, trying to solve what is, I would argue, the single biggest bottleneck to AI scaling today, the time-to-power crisis for these hyperscalers.
So the question we really have to answer, based on the material, is whether this unique strategy gives NUI a legitimate high-potential valuation, or if the stock is still just purely speculative, resting on future execution and partnerships that aren't even confirmed. I'm going to argue that the combination of strategic foresight, their regulatory advantages, and corporate cleanup efforts, they all point to a legitimate infrastructure play that justifies its premium.
Okay, I see why you'd think that. I really do. But I come at this from a fundamentally different financial perspective. The strategy is compelling, I'll give you that. Solving the energy crisis for AI is a huge addressable market, no question. But the current valuation is trading almost entirely on that future growth story, on that terminal value, and it seems to be completely ignoring the pretty grim financial realities and the extremely high execution risks. When we actually look at the balance sheet, the price-to-book ratio, that's the P/B, it's a stark negative 941. Now, for listeners, that number means the company is valued far, far beyond its tangible book value. Specifically, it signals negative equity, and that's crucial. Negative equity means their liabilities are greater than their assets, which confirms the company has no tangible balance sheet support. Until their Texas Critical Data Centers project, the TCDC, is actually operational and has a firm lease, this company is carrying a very serious going concern risk. So this is, at its core, a high-stakes bet on something that might happen, not on any current fundamental strength.
But that structural deficit is exactly what the pivot is designed to fix. It's why the market is assigning value to the solution, not the legacy balance sheet. The whole investment thesis here rests on vertical integration of power. Think about the core problem, right? A traditional data center developer in, say, Virginia or Arizona, they're facing grid interconnection queues that can delay power for 36 to 60 months. In the AI hardware cycle, that kind of delay means 2, maybe 3 generations of chips are already obsolete before you even flip the switch. That is a crippling bottleneck. NUAI just bypasses this. They leverage their existing gas assets, 137,000 acres in New Mexico, to generate power right on site in the Permian Basin. It's a behind-the-meter solution.
And that is the key phrase, isn't it? Behind the meter?
Exactly. It allows them to avoid the congested ERCOT grid entirely. And what's more, let's talk about management's confidence. On October 24th, 2025, they terminated their equity purchase facility agreement, the EPFA. For anyone who doesn't know, an EPFA is it's a highly toxic agreement. It lets an investor just buy shares at a discount over time, which creates this constant, guaranteed selling pressure on the stock. So by killing that EPFA, management basically removed a massive dilutive overhang. And that sends a very strong signal that they're confident about securing non-dilutive financing, probably that Morgan Capital agreement, to get the TCDC built.
That is a compelling point on the speed, and yes, de-risking by terminating the EPFA is a positive step, no doubt. Getting rid of that guaranteed dilution is a good thing structurally. But, breathing room isn't the same as cash flow. We have to look at that decision against the company's actual financial state. The Q3 2025 financials, they show a net loss of $4.2 million for the quarter and negative $2.5 million in cash from operations. All of that spending is against the total quarterly revenue of just $159,411. To put that in perspective, $159,000 in revenue for a company with a $200 million market cap, it's basically zero. It just confirms the stock is trading on a pure growth hypothesis. The entire brilliant vertical integration story hangs on one thing: securing a binding anchor tenant lease for that TCDC campus. Without a guaranteed revenue stream, they are completely exposed. And despite all the aggressive retail theories, the whole shadow partnership idea, that binding lease remains completely unconfirmed by any official filing.
Okay, so let's stick with that for a second and connect that strategic advantage directly to the moat that I think justifies the current valuation. The real speed to market advantage isn't just about bypassing the grid. It's about regulatory arbitrage in Ector County, Texas. It's specifically about the air quality permits, because the TCDC location is in what's called an air quality attainment zone. NUAI is going for a minor source air permit. This is absolutely critical. A minor source permit can often get approved by the Texas Commission on Environmental Quality, the TCEQ, in about 90 days. Competitors who are often in non-attainment zones have to get these much more complex major source permits, and that process can take 18 months or longer. That time difference, saving over a year in the deployment cycle, is invaluable in the AI race. That speed to market advantage is the ultimate moat, and it justifies the premium investors are paying right now.
I fully acknowledge the speed advantage. The Ector County regulatory environment is a legitimate competitive moat. I'll grant you that. But speed is useless if you don't have enough fuel for the journey. The financial runway is just too short, given the scale of capital they need to build a hyperscale campus. Sure, the stock surged in November 2025, but our analysis shows that this is really just riding the NVIDIA sympathy play after their positive Q3 earnings. It just reinforced the general AI demand story. It wasn't driven by a confirmed tenant or real financing milestones. This company is incredibly vulnerable to construction delays, to permitting hiccups, and most critically, a failure to turn that Morgan Capital letter of intent into a definitive binding financing agreement.
I'm just not convinced by that, because you're focusing on this external macro sentiment while you're ignoring the structural improvements the company's already made. And to address that broader concern about capital structure, let's clear up the confusion around dilution. There's this fear they'll do a value-destructive reverse split. It's really important to clarify that the ROC-LNH transaction was just a simple one-for-one SPAC exchange, was not a reverse split. In fact, the CEO explicitly said they strategically avoided a reverse split to regain NASDAQ compliance through organic growth. That shows a real commitment to shareholder value, and it's a strong counterpoint to the idea that management is just being reckless.
Okay, that clarification is a positive signal, I agree. It removes one element of potential risk, but it only removes one. The real engine behind the current premium and the next major risk is this persistent, very detailed speculation around the anchor tenant, what the market is calling the shadow partnership. We have to forensically challenge this retail syllogism that's linking NUAI to Microsoft. The argument basically rests on two circumstantial points. One, NUAI uses Context Labs for carbon verification. And two, Context Labs' platform is built on Azure, Microsoft's cloud. Now, the linkage is real. Context Labs' platform is hosted on Azure, but it's pure speculation to then jump to the conclusion that Microsoft must be the anchor tenant. Corporate ecosystems overlap all the time, especially in the cloud space. And this whole thesis is driving the stock without a single definitive 8K filing to back it up. Plus, we have to warn listeners about external risks here. We need to be very clear to distinguish between the legitimate, NASDAQ-listed NUAI and this other similarly named GSCAI entity. GSCII is marketing what looks like a high-risk crypto HYIP, a high-yield investment program, using the exact same buzzwords like AI computing and GPU clusters. The risk here isn't just reputational. It's algorithmic conflation, where trading bots might accidentally link noise from the scam-like GSCAI to NUI's real ticker.
And that risk of conflation is serious, you're right. It shows why due diligence is so important. However, I would frame that Context Labs connection with a different level of technical specificity. I think it moves it beyond just general ecosystem overlap. See, hyperscalers don't generally need simple carbon reports. They require what's called asset-grade data, specifically the cryptographically verified emissions data that Context Labs' platform provides. Why? Because a hyperscaler like Microsoft, which has a very public commitment to being carbon negative by 2030, needs to integrate that granular verified data directly into their own Scope 3 emissions accounting. They absolutely cannot risk unverified data polluting their official metrics. The fact that the TCDC campus requires this specific type of high-integrity data strongly suggests a very sophisticated counterparty, one with aggressive internal sustainability targets, is driving the specifications. And when you add in the confirmed GlobalLink fiber route MOU, which is meant to connect the Permian region specifically to key Azure hubs like Dallas and Austin. Well, it definitely supports the thesis of a deep integration with a very demanding client.
I can concede that the technical requirement for asset-grade data is a strong piece of circumstantial evidence. It is. It's probably the highest quality clue we have. Yet, even the best circumstantial evidence, it's still not a contract. Until that definitive lease is signed, the company is still exposed to the full weight of its current financial situation, that negative equity and the cash burn.
Let's maybe pivot to the trading mechanics then, because they offer some insight into where sophisticated money might actually be positioning itself. If the fundamentals are weak, well, the market microstructure can tell a different story. We see consistently high off-exchange ratios. For instance, it was around 92% on November 21st, 2025, and high short volume, often over 50%, happening in dark pools. This suggests something more complex than just retail flow. It suggests pretty substantial institutional accumulation, or maybe complex market-making arbitrage, where smart money is positioning for the upside.
I'm sorry, I just don't buy that high short volume automatically means bullish accumulation. We have to clearly distinguish between short volume, which is mostly a function of market makers providing liquidity, and actual short interest, which represents real directional bearish bets. The cost to borrow shares, yes, it did spike to 80% annualized back in August, which shows some tightness, but the total short interest is still pretty modest at around 2 million shares. And crucially, the days to cover ratio is extremely low, somewhere between 0.3 and 0.4 days. Now, for our listeners, that ratio tells you how long it would take all the current shorts to buy back their shares. Since it's less than half a day, it means they could all get out very quickly without causing a major price spike. So the likelihood of a classic violent short squeeze, it's quite low.
This recent volatility feels more mechanical and liquidity-driven, not necessarily a sign of massive institutional conviction.
Well, at the end of the day, I still maintain that NUAI's asymmetric potential is undeniable. The combination of the corporate cleanup, like terminating that toxic EPFA, and the compelling mechanics we're seeing in the dark pools, have strengthened the structure and, I believe, indicated institutional interest. Most importantly, the strategic pivot itself, generating power behind the meter, coupled with that regulatory speed advantage, it addresses the most critical bottleneck in the entire AI supply chain. All of these things create a strong foundation for future growth, provided, and this is the key, they successfully secure that major tenant and finalize their financing.
And I would reaffirm that the execution chasm remains incredibly wide. While the strategy is sound on paper, and certainly necessary for the industry, the financial instability, the negative equity, the high cash burn, it demands heightened vigilance. The current valuation just relies too heavily on circumstantial evidence about a tenant and that expected MOG and financing. Those things remain the holy grail for this stock, and without them, there's not much else. Investors have to be prepared for some extreme volatility until the TCDC project moves from being a projection to being a profitable operation.
The discussion around new era energy and digital clearly demonstrates a high-stakes trade-off. On one side, you have a potent strategic advantage rooted in vertical integration and regulatory speed, positioning the company as a potential critical infrastructure node for the demanding AI economy.
But on the other, the company faces significant financial instability, negative equity, and high cash burn, requiring the immediate and successful execution of speculative financing and tenant partnerships. The complexity demands that investors weigh massive future potential against very real, present financial risks and speculative market forces.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.